So what activities qualify for real estate professional status? Do you want to wipe out taxes being paid on your rental income? Obtaining the IRS's classification of real estate professional status can be the key. But the question I get all the time is what activities actually count towards qualifying? Most real estate investors think they need a real estate license to qualify for real estate professional status. This is not true. I'll show you what activities and actions need to be taken in order to apply to qualifying for a real estate professional and why it matters for you to help you reduce your tax bill. If you're trying to qualify for real estate investor status and you don't know exactly what you need to do to get there, then stick around, watch this video. I'll show you all the activities, the requirements, the IRS rules to being a real estate professional without needing to get a real estate license. By the end of this video, you're going to know all the activities that are going to apply to obtaining real estate professional status and why it's important, and ultimately to offset your active income with passive losses. I'm going to explain what that means right now. Okay, so what's real estate professional status? Well, real estate professional status is an IRS designation that you file and click a box or check a box on your tax form, and it allows you to treat rental income as active income. And why treating rental income as active income is important is because now you can utilize tax losses from real estate, passive tax losses from real estate rental activities, and use those losses in order to offset active income or defer active income tax payments. When I say active income, I mean W-2 income, business income, or any other investment income generated through stocks or bonds or loans that you make for individuals. And a huge benefit with using passive losses to offset all your active income is you can accelerate these losses by getting a cost segregation study on real estate that you own or invest in. These losses then flow through and defer the taxes that you would have ultimately had to pay. So what are the IRS requirements for you to qualify? Number one, more than 750 hours of real estate qualified activities. We'll get into that. Number two, more than 50% of your working time allocated towards real estate activities. Number three, you do not need to be a licensed real estate professional or realtor. Number four, you must materially participate in the activities of the real estate investment. We'll also get into that. So what are these activities that count towards your 750 hours of qualified activities? Well, according to the IRS, here they are. I'm going to put them out on a list. First, acquisitions, sourcing and identifying deals that you are going to buy. Next, property management, handling maintenance, repairs, vendor coordination. Next, leasing, marketing units, reviewing tenant applications, doing showings. Next, construction oversight, managing contractors and actively managing the construction projects, including renovations. Next, bookkeeping, tracking expenses, budgets, cash flows. Next, traveling to and from properties and documenting, if necessary, what you did while you were there. Meeting with brokers, attorneys, lenders, any vendor that helps you with the real estate investment. Due diligence and underwriting activities, analyzing your property and quantifying the returns. So what activities do not count for qualifying hours to be a real estate professional? Reading books or taking classes. This is considered education. This is not work and does not apply to the 750 rule. Time spent on investor relations. If you're raising money and bringing in other partners, talking to those partners about the investment does not qualify. Any of these activities done by your spouse. These activities need to be done by you as the real estate professional. But there's a caveat to this. If you do file your tax return jointly and you both materially participate in the activities of your rental properties, both of your activities do qualify together as time spent on the real estate professional activities. So if your wife works 10 hours a day helping improve and fix and manage the rental property, and you work 10 hours that day, that is a combined 20 hours and does apply to the 750 rule if you file jointly and you're both materially participating, which you were in the rental activity. Material participation. This is a very important concept, so listen close. So even if you qualify for the 750 hours a year of real estate investing activities, you must also qualify for material participation. So here's a material participation test. Are you actively managing the property and involved in the operations, not just collecting a check? That means you are actively managing the property or some aspect of it, not a third-party property manager or not a construction contractor. You're involved. Here are some of the items on the test. You need 500 hours of materially participating activities. You are the one substantially doing the work. You are doing these activities, managing your properties or investments. Your participation is substantially more than anyone else. No one else is doing more than you on that particular investment or series of investments. If you have more than 100 hours and more than anyone else on an individual property, that also qualifies you for the material participation test. So without qualifying to be a real estate professional, and when I say that, meaning you or your spouse, if you file jointly, one of you can qualify and you will receive the benefits. But if you don't qualify, then you cannot offset W-2 or business income with real estate passive losses. It's not allowed. Real estate professional status is the only way you can do that. If you do qualify, then you can now take these passive losses and offset all forms of income, active or also known as ordinary income from your business or W-2 job, income from stock dividends, income from bonds or treasury bills, income from loans that you make to individuals and interest received. All these forms of income can now be offset with these losses generated from real estate. And if you do a cost segregation study and accelerate the depreciation or losses, now you can use larger losses to offset all of those forms of income. And the great thing is, if you don't use them, you do not lose them. Losses as of 2025 in the US carry forward, and then you can use those carried forward losses to offset future streams of income that are coming in. This can potentially write off 6 figures a year or more in tax liability because you actively participated and materially participated in your real estate investing activities. And a tip that I want to share is if you group them together, if you file a grouping activity, I ideally like to put them in one LLC holding company, all of my ownership shares of all the different funds and syndications and partnerships and properties that I own, they're all owned in their individual LLCs, but the ownership units of each of those LLCs is in my holding company. Then I file a grouping activity. And now anything I do across all of those assets applies to the 750 and the 500 hour rule where I am materially participating and qualified for a real estate professional. This is a huge win, and it offsets hundreds of thousands of dollars, if not millions of dollars of taxes over time. So next time you are paying a large tax bill and you and your wife, one of you is dissatisfied with their career, maybe it's time that one of you become a real estate professional. If you're interested in real estate investing and it intrigues you, possibly you could be a real estate professional and eliminate one of the spouse's jobs. One of my main investors is a plastic surgeon and his wife was a dental assistant. They actually made more money by filing jointly and her quitting her dental position and then becoming a real estate professional and materially participating in the investments. Now the losses that were generated from their investments generated so much in loss that the plastic surgeon's income and all the rental income coming in from the real estate was able to be offset, and that tax was not needed to be paid. That is a key strategy and one that I see couples use all the time where there's a high income earner in a job or in a self-employed business. And then there's another partner that wants to participate and manage in the real estate activities. I think it's the best reason to get married. So now that you know how to become a real estate professional, I'm going to share in what depreciation is and what a cost segregation study does and why all those losses can benefit you as a real estate investor, helping you defer or offset tax long into the future, and then in turn, compound your returns, making significantly more.